Good morning, dear viewers, and welcome back to our channel. Today we bring you the latest updates on the Federal Reserve's recent decision to lower interest rates, marking the first reduction since 2020. This move could have significant implications for the economy, so let's dive into what it means and how it may impact you. For the first time since 2020, the U.S. Federal Reserve has reduced interest rates, bringing them down by half a percentage point to a range of 4.75% to 5.0%. The central bank also projects a further rate cut of an additional half point by the end of the year. The Fed expects unemployment to reach 4.4% by the end of 2024, with inflation forecasted to decrease to 2.1% by the end of 2025. The Federal Reserve's decision to lower interest rates by 50 basis points surpassed analysts' expectations, who had predicted a 25 basis point cut, though market speculation had recently shifted toward a larger reduction. According to the Fed, recent indicators suggest that economic activity has continued to grow at a steady pace. Although job growth has slowed and unemployment has risen slightly, it remains relatively low. Inflation has made progress toward the committee's 2% target, but is still somewhat elevated. The Federal Open Market Committee, FOMC, stated that it has gained greater confidence that inflation is moving sustainably toward 2% and believes that the risks to achieving its goals of full employment and stable inflation are roughly balanced. In assessing further adjustments to the target range, the committee said it will carefully evaluate incoming data, evolving outlooks, and the balance of risks. Additionally, the Fed will continue reducing its holdings of Treasury securities, agency debt, and mortgage-backed securities. The committee is prepared to adjust the stance of monetary policy as appropriate should risks emerge that could hinder the achievement of the committee's objectives, according to the statement released after today's meeting. The FOMC's assessments will consider a wide range of information, including labor market conditions, inflationary pressures and expectations, as well as financial and international developments. Besides the reduction announced today, the committee also indicated, via its dot plot, another 50 basis point cut by the end of the year. The matrix of individual officials' expectations points to a total of 1 full percentage point in cuts by the end of 2025, with another half-point reduction projected for 2026-2026. FOMC officials raised the expected unemployment rate for this year to 4.4%, up from the June forecast of 4%, while lowering the projected PCE inflation rate to 2.3%, down from 2.6%. GDP growth is now expected at 2%, slightly down from June's projection of 2.1%. Looking ahead to next year, expectations are for GDP growth to remain at 2%, with unemployment at 4.4% and PCE inflation at 2.1%. However, officials do not anticipate inflation reaching the 2% target before 2026. The Fed's decision to cut rates by half a point was not unanimous. 11 members voted in favor, while Governor Michelle Bowman opposed the decision, preferring a smaller 0.25% cut. The risks to employment and inflation are more balanced, the Fed said at the conclusion of its two-day meeting, emphasizing its strong commitment to maximum employment and 2% inflation.